Hello and welcome to the APW Partners End of Financial Year Review. We're also going to take the opportunity to have a chat to you about the events that have transpired over recent weeks. Joining me today is Dr. Steve Garth, who is a consultant to the APW Partners Investment Committee. Welcome, Steve.
Yeah, thank you, Jeff. It's great to be here.
Steve, there's a lot to unpack. The last 12 months, there's been a contrast, a very substantial performance in the mid half of the year and a fairly slow start back in the September quarter and a rather flat finish in June.
Look, that's right, Jeff. When you look at the returns of the financial year, Australia up 12.1%. Well, that's better than its long-term average. And look at the developed markets there. They're up 19.8%. That's nearly double their long-term average. But to your point, when you look at the way things work over the course of the year, it's never a smooth ride, as we know, to get there. And you're absolutely right, Jeff. A little bit flat at the start of the financial year. That was when interest rates were still going up, which was knocking the market round. But from about October last year, right up until the end of March this year, markets, both in Australia and the rest of the world, have done really well. There's been a flatlining, as you mentioned, since then. Australia's last quarter was pretty flat, but still 12.1% for the year is a great financial year return.
Almost gold medal standard.
Almost gold medal standard.
So let's have a talk about the global developed markets and emerging markets broadly, and then we might get a bit more granular.
Yeah, so when I show you how the developed markets, you can see I've got here Europe and Japan and Australia and over the financial year, and they're all about the same. In fact, if I put the emerging markets there, it's about the same too. There's one standout there, your gold medal winner, which is the US. So while most markets around the world have returned around 15% or so for the financial year, the US is up over 20% in that period. It's phenomenal.
What's the key driver there, do you think?
Yeah, so Jeff, people often talk about the US is doing so well. It's a little bit of a misnomer. It's not the US doing so well, it's a couple of mega stocks. In fact, one mega stock doing so well. Now, we don't normally talk about individual stocks, but this stock is moving the whole of the developed markets, and that is a stock called NVIDIA. In the chart I've got in front of you, you can see that over the financial year, it was up 190%. Now, that's the third largest stock in the world. And the largest are Microsoft and Apple, which I've got in that chart too. And while they've done well, you can see that NVIDIA's just shot the lights out. So that's really lifted the US market up.
But we have seen a few rumblings developing post the end of the financial year, and in particular over the last week. How has that impacted share markets? And I guess if we differentiate NVIDIA and the AI and the tech sector, is there any differentiation there?
Look, there is. Since we were just talking about NVIDIA and the big tech stocks, let's just stay with that for a moment. Towards the middle of July, you can see the bump we showed you before, but those markets were already starting to come down. And that's because a lot of investors were questioning whether perhaps we've hyped up these stocks a little bit too much. In other words, are we pricing in the future economic benefits of artificial intelligence more than we should have? So those markets were wobbling. What we've seen just in the last week, though, Jeff, is on Monday, the 5th of August, the volatility was one of the highest it's been on record, and markets around the world all fell over. Australia was down 3.7% in the day. Now, we should say it seems to be what I'd term a flash crash. In other words, it's one day of significant downturns, and it's easing its way back now. But it was certainly a nasty shock, and I think it just goes to show that the markets are still in a very sensitive position now.
Well, one thing we haven't touched on is bonds, and we know they've had a fairly challenging period of time. Central banks around the world raised interest rates fairly aggressively from a very low base, and bonds haven't performed quite as had been expected through that process. Interested to know how they've performed over the course of last year, and particularly interested to know how have they performed through the last week or so with this sudden dip in share markets?
Yeah, a great question. Now that we've got yields up at around 4 or 5%, bonds are now doing exactly what they're meant to do. And to your point, Jeff, when the crash came on Monday and markets around the world fell over, bond yields went straight down, which pushes the prices of the bonds up. And that's exactly what you expected. So the bonds were there as a cushion for the falling equity market, and that's what we expect.
Yeah, so they've done what they needed to do, which is very reassuring.
Exactly.
Fantastic. Well, thank you very much, Steve. Are there any final thoughts you'd like to leave with our viewers for today?
Oh, I think the recent events we've just been speaking about, including the review of the financial year, Jeff, just reinforces how important being disciplined is, not changing from the portfolio that's been designed to meet your goals, staying with it, and being diversified both across markets and across sectors. So you pick up those sectors that we can't tell in advance who's going to be the best company or the best sector or the best country. So you want to hold them all, and that's how you get the best outcome.
And avoiding the distractions of focusing too much on short-term events.
Don't focus on short-term events.
Steve, thank you very much for those sage words and for giving us an update on financial markets over the year that was and in recent weeks. And to you, the viewers, thank you very much for your time, and we look forward to speaking with you again in the next quarter. Bye for now.